Good afternoon and welcome to Markets Today. Today we are actually covering the Africa Summit and trying to understand what is happening on the global stage with regards to trade and economic growth outlook. What does this mean for Africa? And more importantly, what does it mean for you in Kenya as an investor across the different asset classes? With us on the stage today, or rather in the show, we are hosting Razia Khan. She is the MD as well as the Chief Economist at Standard Chartered. She covers Africa and the Middle East, is based in London, but today she was presenting her views on the economic outlook, both at a global stage and in Africa. Welcome to the show, Razia Khan. Welcome to the show, Razia.
Thank you.
All right, fantastic. So give us a view. What are your views on with regards to economic growth on the global stage as well as in Africa?
At this point in time, there's a great deal of uncertainty. Markets have been very fearful that escalating trade tensions will eventually translate into weaker economic growth. All of the data points, especially from those economies that are really dependent on trading, are watched very closely.
Right.
We already know that in the US, the Fed, with some concern about a slowdown, has started to cut interest rates. And across emerging and frontier markets, we've seen a dovish wave, a tide of central banks all looking to cut interest rates as well. What this fundamentally reflects is some fear that the global economy is slowing, that even though there might be an attempt to backtrack on escalating trade tensions, it's a little bit late. The uncertainty is out there. It started to impact actual investment flows and real economic data.
So dovish sentiment and slowed economic growth, at least at the global stage. What do these two key things mean for Africa today?
So for Africa, there's a very interesting relationship with global growth generally. In the past, and this is true over many decades, whenever there has been a global economic shock, it has tended to transmit to African economies, and usually the impact is a lot more severe a year after that global shock.
So this would potentially be 2020, 2021?
Potentially, but this time around we are looking at what looks to be a fairly mild slowdown. Yes, there's been a slowdown, but no one is thinking this is it, growth is collapsing. That would not be the correct characterization. And for Africa, even more interestingly, what has kept average growth down in Africa from around 2015 was weak commodity prices. Commodity prices are now recovering. The bigger economies in the region have shown signs of recovery, and the expectation for the very biggest economies, so Nigeria, South Africa, Angola, is that in the years ahead they're actually going to be doing better. Very interestingly, this could be the first time that we see something of a slowdown in the global economy with an actual acceleration in average sub-Saharan African growth.
Oh, this is very exciting. And I like that you've talked about commodities and the prices and the impact on some of these economies. When you're talking about Nigeria, what has changed 2015 and today? Is Nigeria in a better state or not?
Well, the situation, of course, isn't without its risks. So put a question mark around that still. But looking at the Nigerian economy, when oil prices collapsed in 2014, the impact in Nigeria itself was made a lot worse by the choice of exchange rate policy. Nigeria's government initially, after allowing for some depreciation, just froze the value of its currency. And that meant that entire external shock was transmitted directly to the Nigerian economy.
Right.
Now that there has been the adoption of at least some market flexibility, Nigeria's in a better place.
And is this the different windows, the exchange windows?
There's one exchange window which is more market determined than the others, and this is of course important. But we shouldn't forget that oil prices have since recovered. With the latest set of GDP data for the second quarter, Nigeria's oil sector was growing over 5% year on year. The problem for Nigeria is that the rest of the economy, the non-oil economy, is still pretty weak. So the expectation is it does get better in the years ahead, but it's not going to happen on autopilot. It will require actual reforms to bring that growth acceleration about.
So what does that mean for investor sentiment, both at a global level and looking at Nigeria? And I ask this because I'm trying to to get us to painting a picture with regards to Kenya later on in the show.
So you ask a very important question, because across the board, what we find is that investors act not just as though Africa is one country generally, but as though all emerging and frontier economies a single asset class. And when times are uncertain on a global level, what you tend to see is risk appetite receding. As soon as there's some glimmer of hope and things will look somewhat better, you might see periodically risk appetite coming back. The key thing is that it hasn't come back in a sustained way for emerging and frontier economies. And this is the challenge that a lot of Africa will have to grapple with right now. Why? Because Africa is still very dependent on the rest of the world and capital inflows from the rest of the world for financing the investment that needs to take place. And if we're seeing those capital inflows not flowing as easily as might be the case under more robust circumstances, it's a problem.
Okay, that's very interesting because you're bringing out the element of expecting volatility with regards to foreign inflows into different asset classes depending. And that certainly explains the outflow from the fixed income markets in Nigeria. Do you have a sense of what's happening with the equities there? Is there increasing inflows into equities there? Are they sector specific? Because we are seeing growth in the oil sector, but not in the non-oil.
So Nigerian equities haven't really reflected any particular growth optimism. And partly it's been driven by global factors, partly it's concern around regulatory risk in Nigeria, and in particular, central bank efforts to try to get the banks to lend more. There are concerns that a lot of the better run banks in Nigeria, listed on the Nigerian Stock Exchange, have had lower loan deposit ratios than a lot of their counterparts. Suddenly there is regulation saying this will be the minimum come the end of September. And the equity market, the price action that we've seen really reflects this concern that forcing the situation, forcing the banks to try to lend more, never goes down very well.
What are you seeing when you're looking at Kenya today?
If we look at recent growth, 2018, of course, was enormously upbeat. Already in 2019, there are worries about the sustainability of that level of growth simply because there have been adverse shocks. We have had the impact of the drought. We shouldn't forget that 2018 was the Kenyan economy growing off a particularly weak base. A lot of 2017 had been lost in extended election period. There's a drought in 2017. So 2018, the numbers looked good, but a lot of it was reflecting this renewed momentum, renewed vigor in the economy off a period when activity had been held back. The big question for Kenya is what kind of growth can be sustained in the medium term, especially as the government comes under more pressure to reduce its fiscal deficit?
That's a pertinent question because every time we're talking about GDP and the growth, there's always the numbers look good. Actually, Kenya looks perfect on paper. We're seeing improving ratios with regards to the current account deficit, maybe not the primary deficit. But then the concern is always this. Razia, it feels like our growth is being led by debt in this country. So the government is taking debt and it's extending this debt to development projects. But when you walk on the street, Razia, many people are complaining. And they're saying they're not feeling these numbers that are coming out. So what are this? Do you have comfort in the GDP numbers that are coming out? Or really, how should we look at the GDP outlook for this economy?
So first off, a big driver of GDP trends earlier on were the really big infrastructure projects. And we already know from government that there is going to be a change in approach. The emphasis going forward is going to be on a lot less on debt-driven growth. The big four will unlock opportunities on a much more micro level, if you like, and there will be specific funding, as we've already seen with the housing levy, for example, to make those big four initiatives realizable. That isn't necessarily a bad thing for Kenya to be doing. It's saying, look, there has been the accumulation of a great deal of debt. When one looks at the debt service to revenue ratios, that is in a fairly uncomfortable space right now, and here's the corrective action. But the question is, in order to properly reassure on debt going forward, Kenya will need to prove that it can sustain its GDP growth very easily. And that would be fine. The Kenyan economy has a lot of strengths. It has a vibrant private sector. And there should be some thinking that the private sector can take over from government as the engine of that growth. However, the missing ingredient, of course, has been the credit growth. The impact of the loan rate cap and the fact that banks have seen sluggish credit growth for some time may well mean that there is a cost to the Kenyan economy at a time when Kenya really needs the private sector to be firing on all cylinders.
Can this GDP be sustained, the growth rates that we're seeing? Is that a yes from you, is it a no? Or what needs to happen to sustain the rates that we're seeing?
From an economist's perspective, at least we've got the tools to answer that question.
Okay.
What are the building blocks of higher GDP growth over time? What have the building blocks been for countries where they saw sustained high rates of GDP growth? And there were two factors that really stood apart. The first one, and it stems from the other, is that investment was sustained at a very high rate.
Okay.
Usually, it was sustained because there was a high rate of what we term domestic savings mobilization.
And what were those rates at a national level? Was savings up maybe over 30% for the countries that did well? And how does that
For the countries that did really well, they had investment rates of over 40% of GDP and savings rates that didn't lag too far behind. And this does cast a spotlight on Kenya's own savings trajectory.
We're very low, actually.
We've got to look at, the aggregate of everything.
Yes.
So on a corporate level, you would look at retained earnings. Have corporates been profitable? Are they putting some of their profits back into new investment? How much are their retained earnings adding to corporate savings? At the individual level, how much are people saving and how much are they incentivized to continue to save? Inflation is a big part of that equation over the. And then at the government level, this tends to be a major swing factor for a lot of countries. But when we look at the scale of Kenya's fiscal deficit, even knowing that it's come down from the peaks that we had seen in recent years, even knowing that there is a fiscal consolidation effort underway, the question needs to be asked, could more be done to ensure even higher government savings?
But what can be done, actually? Beyond if more can be done, what can be done? Because it feels like Treasury is in a tight spot with regards to it has to fund expenditure. Expenditure largely is going either to recurrent expenditure, paying wages, but then now there's the added liability or the added expense line of paying back your debt. So what can they actually do to actually improve this number?
It's very instructive to look at what economists call the primary balance. And this is strip out the debt service. Kenya has to meet its debt obligations. That's a given. There's not much it can do about that. Look at the basic difference between spending and revenue. On the revenue side, there has been an issue. There's another relationship that we look at closely, and this is tax buoyancy. It's the relationship between revenue growth and the underlying GDP growth in an economy that would be driving the revenue growth. In recent years, Kenya has done really well in GDP growth, but that hasn't fed through into the same kind of revenue momentum. Tax buoyancy seems to have changed, and we know that there has been technical advice from the IMF. We know that some of the reforms on board. But if you compare what Kenya has done with what we're seeing from a lot of peer economies in the region, perhaps there is room to go for more substantive revenue measures. I was reflecting on this, looking over my notes on Kenya for the last few years. Occasionally one picks up that notebook and reads through it. And before every budget, 2018, 2019, there is this expectation in the market that there are going to be big revenue measures. There was a time when we were talking about that 20% capital gains tax. We were talking about a much higher top rate of income tax. There was a lot of talk potentially about other tax measures, 16% VAT on fuel. And when none of that has been realized, it does beg the question, is Kenya really doing all it can? Has it taken sufficient action on driving revenue?